talking about one of the subjects which has taken the entire market by storm. I'm talking about nothing other than the speech by ICICI Prudential, Mr. S. Naren. But this has been an exception.
That speech has, kind of rocked the market. I think these kind of statements gain importance when the markets are already in a nervous state. One statement which is coming and which is getting flashed in every media, any of those extreme reactions happen because of some black swan event. In fact, I happened to meet two fund managers in the last 2 weeks. I think what people need to have is patience. People need to have realistic expectation.
This also, promotes some sort of risk in the economy, both in terms of the confidence and also the expectations that these SMEs will perform.
It's like, a bride or a groom looking their lifetime best on that wedding day.
In the speech specifically, there was a lot of talk about SIPs.
Last 3 years, 4 years, there is this war cry. Who jumps into the swimming pool without a trainer? Don't go into that Zerodha and grow and all that and say that, okay, I'll start investing directly.
Hi everyone, today we are here on another episode of Beyond Just Returns, talking about one of the subjects which has taken the entire market by storm. I'm talking about nothing other than the speech by ICICI Prudential, Mr. S. Naren, which talks about a lot of controversial topics. Fund managers usually refrain from talking about these subjects in a very straightforward manner. Majority of times they're very ambivalent in terms of what they talk about when it comes to markets, but this has been an exception. And hence this requires for us to talk about it in depth. The perfect subject for Beyond Just Returns. Today I have with me none other than the MD of Ladder Up Asset Managers, Mr. Raghavendra Nath, to talk about this subject and give us some insights on what the statements actually mean. Should we be worried about them? Should we be concerned about what's happening in the markets right now, in continuation to the downfall that we were seeing? So let's start with the most important line that was mentioned in the speech. So first of all, welcome.
Thank you.
So the first question is that there was some talk about how investors should get out of small and mid-cap right now. What is the theory behind this? Do you see enough facts to substantiate this statement?
And first of all, I think that speech has, kind of rocked the market and everybody. And I think every media outlet has spoken about it, debated about it. And it's not very old, just a week old statement. And I think these kind of statements gain importance when the markets are already in a nervous state. So markets have actually, so it's around August, September, everybody was expecting that the valuations have become very rich.
True.
And markets should take a breather. And indeed, markets basically corrected from that point onwards. And, while the broader market indices have corrected 8%, 10%, 12%, but individual stocks have seen a deeper correction. So when people are already concerned, and where is the market headed, a statement like this is obviously read out of proportion, So
Okay.
From a fund manager's perspective, maybe he was trying to give a guidance on an overall basis in terms of cautioning people, but that caution has actually been taken to an extreme,
Correct.
But just to if we have to dissect that statement, and I think that one statement which is coming and which is getting flashed in every media is, get out of small cap and mid cap, lock, stock and barrel.
Correct,
And
you're right. Some news
yeah.
have also covered that you should stop your SIPs
So
in
yeah,
small
yeah,
and mid
yeah,
cap
yeah.
and move to large caps
Yes.
only or hybrid
Yeah.
funds.
So the thing is that lock, stock and barrel is, I think, an overreaction. Okay, because markets, in my experience, and when you look at last 30, 35 years of data, markets have never ever reacted extremely, in a very short period of time. Any of those extreme reactions happen because of some black swan event. Like, for instance, in March of 2020, The entire world had stalled. The economic activity globally had completely stopped, and that was a black swan. Nobody expected that this can ever happen in the world, and that's how the markets reacted. Or let's say in during 2007, when the global financial crisis happened, the entire US financial system was on the brink of collapse. Nobody had ever expected that will happen.
Right.
And that made a correction. Or in 2000, when the technology bust happened, those dot-com companies without any business model, without any revenue model, were getting listed, and they were basically getting inflated. It's like sand trading at the price of gold. Okay. So that time there was a, when the moment people started realizing corrections were steeper. But do you think that we have been in a situation like this for the last 3-4 years? The economic activity post COVID globally has been very strong. India has been stronger, and because of the kind of initiatives that the government has done, the overall size of the economy has become very large. Equity markets are attaining more and more depth. More number of players are getting listed in the market. So the overall market activity and economic activity has been strong, and that's the reason why equity markets have done so well.
Right.
And in any market, basically, when bullishness happens, speculative forces also come in. So market pendulum shifts towards that greed, during some period of time, and for a small period of time, like it shifts towards fear in tough times. Okay, so that is that element of greed which you can say has to get corrected. Okay. But saying that the entire small cap category will see substantial correction, I think it is an overstatement.
No, interestingly, you also mentioned that there are strong fundamental drivers to our economy, which is what was mentioned in the speech also. It was not just, talking about only that you should get out of small caps. He also mentioned about that macroeconomic drivers are strong. But in my mind, at least, that's opposite of what he was mentioning when it came to the getting out of market right away.
Yeah.
So it's both. It is saying that the fundamentals are strong. It's also saying that this is not the right time to be in small cap, mid caps because the valuations are high. So two parts to the question. One, is it that the fundamentals are strong and hence the investor shouldn't worry too much right now? And secondly, is the valuation high valuation issue only restricted to small caps, or
Yeah.
are large caps also privy to
I
that?
think very so basically when you say that the fundamentals of the economy are strong, okay, and almost every segment of the economy is doing better than what it has done previously. Now, when that happens, it's not that only large caps are going to capture that opportunity, or only mid cap, or only small cap. I think every segment, every business, whether small or large, is going to capture that opportunity, less or more, depending on how good that management is, how aggressive is that management in capturing that opportunity. And economic activity is not a 3 months, 6 months phenomenon. India has been on an upward journey for the last 25 years, and it may remain in that path for another 10-15 years, for all you know. So in every segment you will find opportunities. And when the valuations basically are becoming expensive, yes, on an overall basis, small cap today is quoting at much higher premium to the averages than large cap. So as a category, you can say that yes, small cap is more expensive than large cap, and therefore the potential returns from small cap could be lesser if you invested today. But that doesn't mean that if you invest in small cap, and some small cap company or a portfolio of small cap stocks, then it will necessarily not give you returns. Because in fact, I was talking to one of the small cap fund managers, and in fact, I happened to meet two fund managers in the last 2 weeks. And both one of the some of the two senior most fund managers in the industry. One guy has a portfolio where his average PE is around 22 times, you know, in the small cap universe, and the other guy has a portfolio which has an average PE of 30 times. The expected growth of this second portfolio is around 30-35% over the next 2 years. So this fund manager expects that his portfolio companies on an average will deliver 30% profit growth. Okay. And the guy who has a 22 times, his expectation is that his portfolio will deliver 18 to 19% profit growth. So now the point is that a fund manager is one fund manager is very conservative in terms of basically the small cap segment, and therefore the growth expectation that he has is also lesser. Now that portfolio will be much lesser volatile than a portfolio which is basically a little more expensive, but the growth is also high. So somewhere valuations are aligned with the growth expectations. Okay. So in some cases, that difference for short term will basically become very large, where the growth expectation is 20 let's say 20%, and the stock is quoting at a valuation which doesn't justify that growth, or if the growth gets hampered, then the valuation will get corrected. But these are very short term phenomena. In fact, if you look at last 4 months, stocks have actually corrected 20, 30, 40%. So something which was expensive, let's say just 3 months back, or 4 months back, is actually trading, at much reasonable valuation. I was looking at, in the afternoon today, I was looking at 3M India. 3M India 4 or 5 months back was trading at 37,000. Today it's trading at 27,000. 4 years back, the same stock was trading at 18,000 rupees. Okay. That stock, in terms of profitability in the last 4 years, that company has grown around 35-40%, maybe 45% in terms of profit. Okay. So, okay, at 37,000, it was a little more expensive than what it was, let's say, 4 years back. Right. But after getting corrected almost 18-20%, it is almost at the same valuation at what it was available 4 years back. So 18,000 and 27,000, which is 50% high. And the profit of the company has also grown by 40-50%. Fair. So the point is that, this valuation correction can happen sooner than we expect. Okay. And it can happen in a matter of days. So I think what people need to have is patience. People need to have realistic expectation. So I would turn that statement to say that in the last 3 years, you have made 35% return in small cap, probably, which is completely unjustified. No company basically grows at 35% year after year, or a portfolio cannot grow 35% year after year because the profit is not growing 35%. Sure. So your expectations need to come down, But if you're investing in good quality businesses, you will definitely make money.
Interestingly, since you mentioned about how the market dynamics are changing, talking about the IPO frenzy, we've seen, especially in the SME segment, the retail participation has gone up substantially, which means that the outlook on, or the expectations of these companies to perform 35%, 40% is being, held by a significant chunk of retail population. And hence this also, promotes some sort of risk in the economy, both in terms of the confidence and also the expectations that these SMEs will perform at this, growth rate. So is that also a risk that was mentioned in the speech?
So I don't think he mentioned about IPOs, but I think that's one segment where I can for certain say there is a bubble. Okay. And when I think last year we were looking at the data of SME IPOs, and we figured out that on an average oversubscription was 165 times. So a company wants to raise 10 crore and people say that, okay, please take my money. And they end up basically giving that company 1,650 crores. Okay.
Wow.
And there are hundreds of companies. I think more than 200 companies have approached for an IPO in the SME exchange in the last 1 year. You can for certain say 80% of those businesses basically are mediocre, Okay, only 1 out of 10 or maybe 2 out of 10 will be excellent businesses. Other than them, most of them are only basically coming to the market because they can raise cheap capital, because they don't want to distribute dividends. You have India. In India, the dividend paying rate of companies is pathetic, actually. And so you don't expect that these small businesses are going to basically reward you regularly by dividend. So once you have invested in that company, the only return that you're going to get is by selling it in the market, the share in the market. Okay. And IPO, basically, the people have created businesses out of it. There was a friend of mine. He met me the other day. He says, I want to start an AIF. I said, what will be the AIF? What will AIF do? He says, AIF will invest in IPOs.
Oh,
And I
lovely.
said, how are you certain that you are going to continue to invest in IPOs and make money? It
Correct.
is completely against the principles of investing, that
Correct.
okay, I invest in a business at 10 rupees. When it gets listed, it quotes at 12 rupees and I exit. And then I invest in another business at 10 rupees and then I exit again at 12. If money making was this easy, then all of us will actually stop working and only invest in IPOs.
True.
But so there is a bubble there, I think, and it's waiting to be burst. Probably the market conditions right now are apt for people to realize that you cannot basically continue in this streak. That invest in an IPO, get an allotment, and then sell that shares immediately after listing for a profit. It just
Fair.
doesn't go. In my experience, IPO markets basically do not remain, bullish or whatever, or give you returns for more than 1.5 years, and it's actually been that period. So people have to be very, very cautious when they are investing in IPOs. They are far better companies. It's like most companies which are approaching IPO, they planned for it not today. They planned for it 3 years back, 4 years back. So they had enough time to clean their act.
Correct.
You know, so it's like a bride or a groom looking their lifetime best on that wedding day. The IP for an IPO for the promoter, that company for that company is like a wedding day. They need to look the best. On that day,
Sure.
as so the reality could be different. And
Fair.
so the actual performance of the company could be different. So most of the time, the company's results are just too good to be true. And once the company gets listed, then you will see that the business and whatever has the expectations that you had set were completely away from the reality.
Fair.
So people have to be very. I'm not saying that don't invest in IPOs. There could be some fantastic businesses which were in the unlisted space, where investors have already participated, smart investors, private equity investors, and when they are getting listed, and if you find the price is good, you should. But they are far and few in between.
So, we've been talking about the magical word SIPs, right? So, everybody is talking about that long term में invest करिए, forget your money, एक बार invest करके भूल जाओ and then just sit tight. That's what the magical word SIP has meant for the markets till now. And in the speech specifically, there was a lot of talk about SIPs, and maybe it's time to check where you're invested rather than just sitting tight with the SIPs. There were two periods mentioned specifically. One was the 95 to 2002 period, wherein SIPs did give negative returns, and similarly 2013, pre-2013 period. Just to exemplify the fact that it doesn't matter, only doing SIPs is not the magical solutions to everything.
Yeah.
What are your views on that?
Yeah, so I think what I think he was trying to say in that speech was that very few people look at 20 years, and if you are doing SIP for 20 years, then you will be fine. But if you are trying to do it for 3 years, 5 years, you are in for a shock.
Correct.
That you may actually end up making or losing money, and that's where he cited these periods. Yeah. So I think let's look at it in two parts. Okay, first of all, in my experience, once somebody has started investing in equity, he continues to have equity in his portfolio perennially. I haven't seen investors who come and say that, okay, I'll invest in the equity market for 3 years and then I'll go back to FDs.
True.
Okay, I'm done. Okay. It just doesn't work. Okay. In fact, the more people stay invested in equity markets, the more comfortable they become with the volatility of the market. And they know that, okay, markets may give you shocks, markets may have bearish periods, but there's a light at the end of the tunnel. The sun will rise again tomorrow, and so when all this dust settles, I'll make money again. Okay. And all that loss is only on paper, it's
Correct.
not a real loss. So more the people who have seen multiple market cycles, they become very comfortable with the stock market volatility. So investors who have obviously come in the last 2 years, 3 years, 4 years, they have not seen that kind of cycle, but they will experience, and they should experience. If they experience it sooner than later, the vagaries of the market, it is better for them because they will become smarter investors in future.
Correct.
So running away from the market is not a solution. So when you say that investors are not looking at 3 years, they're not looking at 20 years, they look at 3 years, 4 years, 3 to 5 years. It is they are looking at outcomes in 3 years, 4 years to justify their investments.
Sure.
But most investors, once they have participated in equity market, and if their expectations are realistic, they'll continue to remain invested. Only the people who try to speculate in the market, they get thrown out in the out because they had unrealistic expectations. They took uncalled for risks and they lost substantial capital. So they get. But investors, so an SIP investor is investing in a controlled fashion. Okay. And how is it controlled? Because he's first investing into not one fund. I think there'll be very, very few investors who have invested just in one fund.
Right.
कि चलो हम quant small cap में डाल देते हैं या मोतीलाल के small, and that's it. Most of them pick up 3, 4, 5, 7 funds. So they are diversifying, and then they are giving it to expert managers who are conscious about what they are holding in their portfolios.
True.
So a fund manager, all the fund managers in the mutual fund industry, and I think we can put a blanket statement that everyone out there who's handling investors' money in a mutual fund is a qualified guy. He has enough experience to actually be designated as a fund manager, and therefore he understands the nuances, the sensitivities, the risks, of investing. So the investor is actually investing, therefore, in a very controlled environment, diversifying himself, and then giving money to capable people. So I think when you have started in some SIP, when you are doing for next 2 years or 3 years. So let's say if his statement was true. So I invested 10,000 rupees in September 2024, and let's say after 5 years, I find that money has not returned me anything. Okay, but that's not the 10,000 that I have all invested. Right. The 10,000 that I invested in the month of February of 2025, when the market has corrected 20%. Probably that money after 5 years would have given me 50% return. And if the market were to go down even 10% more, so if I invested another 10,000 rupees in July, that would have given me 100%. So investor can see that my stream of cash flows generated different returns at different, because of the timing of the investment, Fair. So I don't think one should stop SIPs. Just because there's a period where of some exuberance. I won't even call it irrational exuberance. Right. And I think that's about it.
Sure. So within the SIP landscape also, there are multiple types of investors, right? So it may not be just a long-term investor. It could be ranging from a speculator to a long-range investor to institutional investor. So the Indian market's depth is also increasing.
Yeah, of course. Yeah.
So do you think that that's also playing a role in the majority of the investor?
Yeah, of course. So because see, that statement that you said 95 till 2002, somebody who did an SIP made a loss. Okay?
Correct.
But you just look at the market in 1995 and you compare it to 2023. Okay. That time there would have been 10, 15 lakh investors in equity markets. Today, there are probably 10, 15 crore investors in equity market. I think a demat account itself are some 7, 8 crores.
Correct.
There are some 5 crore unique SIPs or investors which are
Correct.
which are in
Five,
the
yeah.
mutual fund. Insurance companies. EPFO is investing 15% of incremental flow, and all of us know RPF, part of the money is going into the equity market. That's crores of investors actually.
True.
So the market character has changed. The number of participants have changed. There were hardly any institutional investors. The first institutional, private equity player came in India in 1995. Okay, so mutual funds were not even there.
Correct.
Open-ended funds were absent at that time. Today, mutual fund industry controls a large portion of the equity market. 37, 38 lakh crore is invested in the mutual fund industry. FIIs were negligible. I think there may not have been any FIIs. Today, 19% of the market is held by FIIs. So the market character has changed. The number of companies which have listed have changed. That time, the entire market was controlled by brokers. Today, brokers are absolutely no control over the market. It's the institutional investors which have control, and which are more qualified, more long-term, more patient, more analytical. So the entire nature of the market has undergone a change. And what has happened as a result of that is efficiency in the market has improved. What does efficiency mean? Efficiency doesn't mean that all investors have all the information all the time. That's a theoretical concept. What efficiency mean is that if there are any excesses in the market, either on the downside or on the upside, they get corrected very fast. So because of the maturity of the market, and so if there's a excess, first of all, we don't know whether there is an excess and all. It's debatable. Every two investors always have different view. One guy will say that 50 price earning multiple is cheap. Another will say is expensive, depending on their mindset and their end goals. So even if there's an excess, that will get corrected very fast. For all you know, it's already corrected in the last 6 months. And even if it's not, then it will correct sooner than later.
Fair. Understood. No, that's quite interesting. But let me get to the most important question now. What should the investors do right now? Should they actually worry about the statement or the speech and the impact of it, which we're already seeing?
I think you should not scoot. You should not jump the ship.
Okay.
The ship is very, very strong. I think the way Indian markets are currently positioned, the way economy is doing, I think there's a lot of money to be made in the marketplace. Okay. When you are investing in market, 10, 15, 20% corrections are par for course. Okay. You have to assume that kind of volatility will hit you every now and then. Okay. And so if somebody doesn't understand that, then he doesn't understand the risks of equity investing. Okay. So for that investor, probably you need to lighten your equity load right now. Okay. But if people understand that the 15, 20% volatility is considered normal in equity market, I think we are only seeing that. Okay. After 4 years of unidirectional market, there was a breather in 22, 23. But if otherwise the markets have been unidirectional for 4 years, this was expected. So if you don't make money for another 6 months, another 1 year, it doesn't mean that you should basically run out of the market. In fact, look at it as an opportunity. Like I gave you that example of 3M. There are so many stocks today which were available 30, 40% higher. And people have to understand that, this correction in valuation, makes those stocks far more attractive than probably just 6 months before, or 8 months before, or 1 year before, So invest in the market. But of course, I think there's a lesson well learned. If people are making some losses in small cap or whatever, that, just because something is rising faster does not, mean that it will continue to rise faster, And, risk management, therefore, is far better. If and I give this example all the time, that if you invested 100 rupees and you got 100% return, it becomes 200 rupees. And if it falls by 50%, you're back to 100. Okay. So by taking high risk and generating high return, it did not matter, because when the risk showed up, all the return that you earned was neutralized.
Correct.
So take reasonable degree of risk. Take that, risk which can pay off.
Sure.
So I think and to do that, you need to basically diversify your investments adequately. And and it doesn't matter whether it's small cap or mid cap or large cap. If you are in high quality, you will make money. If you are in poor quality, whether it's large cap or small cap or mid cap, you will lose money.
Lovely. Perfect. And I think in all of this, we're also missing one part of the puzzle, which is the fact that Indian mutual fund ecosystem still remains distribution heavy. So you have a guidance layer also in the middle, right? So you have advisors, you have distributors who are already, as you mentioned about fund managers, they're also equipped enough to understand what's happening. So is that also protecting the investor right now?
I think a fantastic question, Upasna, because last 3 years, 4 years, there is this war cry. Ki direct mein jao, and invest direct, save that 0.7%. Now, what is more important, saving 0.7% or saving 70%? You are basically, who jumps into the swimming pool without a trainer? I want to jump, I want to learn, so I will save that few thousand rupees and jump into the swimming pool to learn swimming. It just doesn't work. Equity markets are very, very complex. You need to be guided properly.
Correct.
If you don't have understanding, don't try to basically self teach yourself, self learn. And because there are just too many stumbling blocks. Okay. Take help of guides. There are enough and more available around you. You just need to have to see.
Sure.
So don't go into that Zerodha and grow and all that and say that, okay, I'll start investing directly. Those are the investors which are worrying today the most.
Correct.
The investors who have downloaded an app and they are trading on that app, buying this stock and selling that, they are the ones who are in trouble today. If you ask an average distributor, what should I do? Like we are a wealth management business for last 14 years. Till date, I have received 2 messages, in the last 1 week. Should I stop my SIP? And I said, no, you should not. And that's about it.
Sure.
And why has that happened? Because those investors know that if there was a reason to panic, I will press the panic button first. Investor doesn't have to worry. So when you have a good investment advisor, I think you will be in a far, far, better shape and more peace of mind. So if you want to learn yourself, do it with a very small portion of money, but larger portion of money, take guidance.
Correct. Fair enough. I think it's been quite interesting. And the summary of all of it is that we understand that there is slight turbulence in the ship, but it doesn't mean that we stop experimenting and stop experiencing the India growth story, which is still in progress.
Yes.
So thank you so much for the conversation.
My pleasure.